For decades, China's vast holdings of U.S. government debt have been a cornerstone of the international financial system. Not only was China once the largest foreign holder of U.S. Treasury securities, but its position also symbolized a unique and deeply interconnected relationship between the world's two largest economies. It wasn't just about investment, it was about trust, leverage, and global influence. But the situation is evolving. As of early 2024, Japan has reclaimed the top spot as the largest foreign holder of U.S. Treasuries, with holdings exceeding $1.1 trillion. China, meanwhile, now holds around $760 billion, a significant decline from its peak of over $1.3 trillion in 2013. This shift raises critical questions. What's behind China's reduced appetite for U.S. debt? Could this trend have broader consequences for global markets, the U.S. economy, or China itself? And what fills the vacuum as China steps back? To answer these questions, we first need to unpack the fundamentals of U.S. government debt. What is U.S. government debt, and why does it matter? U.S. government debt is the sum of money the federal government borrows to cover expenditures that exceed tax revenues. This borrowing is conducted by issuing Treasury securities, specifically Treasury bills, short-term, Treasury notes, medium-term, and Treasury bonds, long-term. Collectively, they are referred to simply as Treasuries. These debt instruments are critical for several reasons. They fund government operations, from military spending and infrastructure projects to Social Security and Medicare. They are considered the gold standard in safe investing. Backed by the full faith and credit of the U.S. government, Treasuries are low-risk assets, especially attractive during global uncertainty. They set the benchmark for global interest rates. Yields on U.S. Treasuries influence borrowing costs for businesses, consumers, and even other governments. As of Q3 2024, total U.S. federal debt has ballooned to over $35.4 trillion. Ownership of this debt is split between domestic investors, including U.S. banks, pension funds, and the Federal Reserve, and foreign entities, among which China has traditionally played a leading role. Why do foreign governments buy U.S. Treasuries? Foreign central banks and sovereign wealth funds buy Treasuries for three primary reasons. Safety. U.S. Treasuries are one of the safest investments available, with near-zero default risk. Liquidity. The U.S. Treasury market is the most liquid bond market in the world, enabling fast and large-scale transactions. Stability of the U.S. dollar. As the world's primary reserve currency, the dollar gives Treasuries an edge over other sovereign debt. These characteristics make Treasuries a logical place for countries to park excess foreign exchange reserves, especially in dollar-denominated assets. How China became a leading holder of U.S. Treasuries. China's massive acquisition of Treasuries began in the early 2000s. During this time, China's economy was booming, fueled by manufacturing, exports, and foreign direct investment. Chinese goods flooded international markets, leading to enormous trade surpluses, especially with the United States. These surpluses generated massive inflows of U.S. dollars, which Beijing couldn't just leave idle. Instead, China used those dollars to purchase U.S. Treasuries, seeking both returns and stability. From 2001 to 2008, China's holdings skyrocketed from about $70 billion to over $700 billion. By 2013, China's Treasury holdings peaked above $1.3 trillion, making it the largest foreign holder of U.S. government debt. But why Treasuries specifically? The decision wasn't just financial, it was also strategic. Holding Treasuries allowed China to earn modest but safe returns on reserves. Keep the yuan's value lower relative to the dollar, aiding its export-driven economy. Gain leverage in geopolitical and economic negotiations with the United States. Why China is pulling back. In recent years, however, China has begun to shift away from Treasuries. Here's why. The Belt and Road Initiative, BRI. Launched in 2013, the BRI is China's signature foreign policy and economic development strategy. Spanning Asia, Europe, Africa, and Latin America, it involves trillions in infrastructure investments, ports, roads, railways, pipelines, and more. To fund these massive projects, China has tapped into its foreign reserves, reducing the funds available for Treasuries. This reallocation reflects a broader strategic pivot from passive holding to active global investment. BRICS and de-dollarization. China, as a founding member of BRICS, Brazil, Russia, India, China, and South Africa, has been a vocal advocate of reducing dependency on Western-dominated financial systems. BRICS countries are promoting local currency trade, developing new payment systems, and reducing reliance on the US dollar. This includes cutting back on US Treasuries. By doing so, China and its partners hope to insulate themselves from external shocks, like sanctions or dollar volatility, and foster greater financial independence. Gold accumulation. As China reduces its exposure to treasuries, it's significantly increasing its gold reserves. Data shows a steady accumulation of gold from 2015 onwards, often coinciding with declines in U.S. debt holdings. Gold offers diversification, acts as a hedge against inflation and currency risk, and importantly, is outside the control of Western financial institutions. Geopolitical tensions. Rising U.S.-China tensions spanning trade disputes, Taiwan, cybersecurity, and tech restrictions have heightened Beijing's concerns about relying too heavily on dollar-based assets. There's a growing fear that under certain scenarios, Chinese assets in the U.S. could be frozen or sanctioned, as happened with Russia after the invasion of Ukraine. Reducing exposure to treasuries is seen as a protective measure. What happens if China sells more U.S. debt? If China continues to reduce its holdings or even conducts a large-scale sell-off, several outcomes are possible. U.S. Treasury yields could rise. In the bond market, prices and yields move inversely. If China reduces demand, prices could fall, pushing yields up. Higher yields means higher interest costs for the U.S. government. This could complicate efforts to reduce budget deficits or finance new spending programs, especially if domestic borrowing costs rise. The U.S. dollar might weaken. Selling treasuries typically involves selling dollars. A significant reduction in dollar holdings could put downward pressure on the currency. While this could help U.S. exporters, it would also raise the price of imports, potentially fueling inflation. Market volatility. A rapid sell-off by China could create turbulence in financial markets. Treasuries are viewed as the world's safest asset. Any perceived instability could cause global investors to panic, leading to short-term dislocations or capital flight from riskier assets. Other buyers could step in. Despite these risks, the U.S. Treasury market is vast, with daily turnover exceeding $500 billion. Other investors, such as pension funds, insurance companies, and foreign central banks, could step in to absorb the supply. But with Donald Trump threatening to put tariff on all the countries, friends and foes alike, the likelihood of foreign central banks buying U.S. Treasury seems very slim. Instead, there are reports of Japan selling massive amount of U.S. Treasury, creating a shockwave in the markets, which forced Trump to pause the tariffs. In the last-case scenario, the Federal Reserve could also intervene to stabilize yields, as it has done in past periods of market stress. Is this a strategic decoupling? What we're witnessing may be part of a broader economic decoupling between the U.S. and China. From tech restrictions and tariffs to capital controls and strategic investments, both nations are reassessing their interdependence. For China, reducing treasury exposure may be just one piece of a larger puzzle, one that includes building a digital yuan to challenge the dollar's dominance, creating financial tools and institutions outside Western frameworks, for example, the Asian Infrastructure Investment Bank, encouraging trade settlement in non-dollar currencies. Meanwhile, the U.S. may also see advantages in reducing its reliance on China as a creditor, especially as political friction escalates. So, in conclusion, China is looking to create a new financial system which they can have more control over. China's massive investments in U.S. debt once represented the pinnacle of globalization, mutual dependence that bound the world's two largest economies together. Today, that dynamic is shifting. China is diversifying away from treasuries to pursue geopolitical ambitions, reduce vulnerability, and reshape its global economic role. At the same time, the U.S. is adapting to a world where China is no longer the dominant buyer of its debt. The implications are significant, not just for Washington and Beijing, but for global investors, currencies, and financial institutions. The move away from treasuries signals a possible new era in international finance, one marked by decentralization, rising multipolarity, and shifting alliances. The road ahead will depend on whether other nations and institutions step in to fill the gap, and whether U.S. policymakers can adapt to a world where one of their largest creditors is stepping back.